Hello and welcome to another weekly review. My name is Grant Collins. I'm an independent economist with AIM Research. And today I want to give you an update on all the data that came out this past week, as well as get you ready for the week ahead. So last week was a pretty light data week. There was only a handful of things that came out. Most notable, the ISM non-manufacturing or the services PMI data came out. You also then had the factory new orders. You had some mortgage applications. You had the balance of trades and looking at the deficit of import and exports. And then finally, used cars, consumer credit, and initial jobless claims. With it being a little lighter, I really want to focus on just a few of those data pieces and then really get you ready for this coming week. There was some notable things in here. Like, for instance, the ISM non-manufacturing service data came in just slightly lower than consensus. Consensus thought that services were going to continue to accelerate, jumping from 51.9 on the prior month all the way up to 52.3, but it actually came down. It actually dropped to 50.3. And so that was surprising to see some weakness in the service sector. Now, for it to be considered contractionary, it's got to be below 49.9. So at 50.3, it's not really contractionary. It's just somewhat slowing here. What else was interesting was the balance of trade reports. Seeing the fact that the deficit widened a little bit was another surprising factor there. We also saw consumer credit changes. That I thought was a very interesting piece of data as well, showing that yes, consumers are tapping their credit lines a little bit more than normal, but from an overall level perspective, it doesn't necessarily seem concerning. To me, what stood out this week was the initial jobless claims data, and that's what I'm going to spend time to show you some charts on. It's important because the Fed's going to be meeting next week, and the only other piece of data that they have before they meet is an inflation data that's going to come out on Tuesday of this coming week. You're going to get both the headline and the core CPI, and then you're also going to run right into the PPI the day of the meeting. So you're going to have the jobs report behind you, and you're going to have the inflation report behind you, and then the Fed's going to have to set policy. So today I'm going to dig into that initial jobless claims and why I thought it was so interesting. I'm going to dig into what I think the Fed might do at this current meeting. And then maybe what does that mean for the market going forward from here? So let me start by sharing some of my screen here and sharing some charts here. Here we go. So here's the initial jobless claims. Initial jobless claims came in higher, came in at 261,000, and you can definitely see a trend starting to form as it's really started to hook higher here. I think I mentioned this before, but over 300,000 would be concerning. That would definitely set some precedents for some recessionary periods. Again, if we can just maybe hover over some of those periods in the past here. You can see a recession here. You can see a recession here. So, I mean, if I keep kind of drawing this line, you're going to really get close to about 300,000. So we're not quite there yet, but at 261, you definitely start to see that trend creeping higher. Continued claims hasn't come back to that 1.8, but came up a little bit, 1.757. So again, that general trend is coming up a little bit. The Sham rule, the Claudia Sham rule, again, ticking higher. So it's no longer at 0, but it's 0.03. That's going to look and feel very similar to the continued claims. So watch those. Here is something that I've been using to broaden the employment indicators. It's the Kansas City Fed Employment Index. It's comprised of 24 labor market indicators. So it does, in my opinion, basically look at the labor market in its entirety. It's not taking one piece of data over the other. It's kind of aggregating them all together to give us a reading. You can see that current reading's at 0.93, so it's still above trend. I'm sorry, above what they would consider full employment. That squares really well with what I've been seeing. But what is interesting is the deceleration that's been happening. It's been happening for 7 consecutive months. The labor market index from Kansas City has been declining, and you can see that it's pretty deeply negative when you subtract it from the trend rate in yellow there. That deeply negative number here looks very similar to the other two recessions since this data has been printed. And so I think that's important to think about as well when we think about this employment cycle. Now, why is that important? It's important because of the Fed meeting. It's important for the stock market. The stock market has just continued to run away despite seeing some strong data here. And the reason why I think this is important is because if the data remains strong, that has to put a bug in the Fed's ear to say, hey, maybe we should raise interest rates. Maybe inflation's not going to come down like we thought it was. Maybe it's not going to get back to 2% as quick as we thought it was. That's important because the Fed's also going to release their SEP, or the Summary of Economic Projections, at this meeting. And so we'll get a revision to their inflation forecast. And I think that's going to be important for us to understand how quickly they see that coming down. But the market now is basically painting a picture of all clear. I mean, it's almost up to 4,300. That's really challenged my view because I thought we were going to stay kind of in this range-bound channel. And I think that's still a possibility if the Fed continues to raise interest rates and continues to tighten on both the financial economy and on the real economy at the same time. Now, despite the fact that the market has been rallying so much, it has been very narrow. And I think I've talked about this before. Technology, discretionary, and communications are really the strong spot of the marketplace, where everything else is negative except for materials and industrials. And this is interesting because you've probably been seeing charts floating around of manufacturing picking up quite a bit, or maybe even structures, as far as that last GDP report showing a strong investments being made in structures. And so maybe you're seeing a little of this because of what some are saying, onshoring. I'm digging into that. I'm trying to look at the investment component. If you remember my framework when we're talking about the economy, I believe that there is of course, a cyclical trend to the economy, and that cyclical trend has an upper and a lower barrier. The upper barrier, we know this from John Hicks, is full employment. So you can't grow more than the employable workforce that's available. And that's because these people are there to create the products and services that we ultimately need. But there's also a floor. This floor is what Hicks believe is autonomous investment. And this autonomous investment acts as that shock absorber along the way, that when prices or when the economy gets so depressed, a lot of investments get made, and that helps you accelerate through the next cycle. So I'm going to dig into this data because if there is this onshoring, these materials and these industrials look really attractive. So give me some time. We're going to spend some time kind of combing through all the investments that are being made in this cycle. I would imagine that it's going to be in computers and software. And then if you're already seeing these charts float around on manufacturing, the onshoring conversation is also picking or coming into the conversation as well. So that's important for two reasons. One, that can help get us through this kind of growth slowdown that we've been experiencing, but it could also maybe paint a picture of how the Fed might be looking at this below trend economic growth as well. So I got diverted a little bit here, but again, it's important for us to look at the market because the market's going to be reacting next week to really, in my opinion, two things. It's going to be reacting to the inflation report that comes through. If inflation is higher or stickier than everyone's expecting, then we could see the market kind of sell off and come back into that channel range that I've been talking about. Or vice versa, if inflation comes down harder, the Fed decides to pause, the market may continue to show some signs of strength. And that's kind of the way that I'm looking at it. Just to set up the week, volatility is extremely low and continuing to drive lower. Credit spreads are still coming down off of their peaks here. And at the same time, you have bullish sentiment that really picked up. It was roughly 29% last week, and now it's 44% bullish. And you can definitely see a pretty clear bottoming and a reacceleration here as well. So let's square this before we talk about interest rates and before we talk about the Fed. So we got a really strong employment report showing 339,000 jobs added. at the beginning of the month. That I think we talked about, there's only a handful of sectors that are doing really well. It's mining and lodging, it's private education and healthcare, and it's government employees. So those three areas to me seemed like bright spots, where the rest of the report still showed some kind of sideways move. Moving into the initial jobless claims, we saw a spike in jobless claims, and we finally got the Kansas City Fed labor market indicator on Wednesday of last week, and that showed a consecutive 7-month decline. So to me, that paints a picture of a slowing labor market, even though there were still some job added. So I say that to highlight the market. The market has been rallying off the back of that the Fed may be done, and that this Fed pause could be the reason for the rally, on top of the fact that you got a big debt ceiling relief as everybody decided to kick the can for another couple of years. So that sets us up for what could happen with the Fed. Now, really what I think is going to be interesting is how the Fed talks about it. So it's less, in my opinion, on what they do and more of what they say. So really pay attention to the forward guidance that Jerome Powell is going to be providing this week. To me, it seems like they will raise 25 basis points or 0.25% at this meeting. That's going to take their range here from 5.25 to 5.25, 5.5. So you're probably going to see it move up just a little bit higher than where it is right now. The 1 month right now, just real quickly, the 1 month is trading right within that band at 5.25. So the 1 month tends to float into the channel. As you can see, I'm going to toggle back and forth here. The 1 month's in blue. And so it tends to fit really well in this. Again, I'm going to draw it out. Red channel, and then I got a black channel here at the top. So the 1 month is back inside of this channel, and I would expect it to maybe come back up if they raise 0.25%. The 2 year is also interesting. The 2 year has been coming up. The 2 year setting at 4.52, and you can see how that has turned the corner here as well and has been working higher, trying to take cuts off the table, because that's what this move was. This move right here was them cutting interest rates. That was not correct. We do think they're going to hold rates high for all of this year. And so now the 2 years having to reprice and come back up into that range here. That's important because, again, the 2 year is a leading indicator for what the market thinks the Fed's going to do. The 1 month is actually really closely tied to the Fed funds rate here. So I see this as a very important indicator for us, because primarily I think the Fed will ultimately end up, like I said, raising 0.25%. I personally think that they should do nothing at this meeting. I think there's plenty of evidence to show that they're restrictive. One of those pieces of evidence is sitting in our stock market data chart, which is the 3-month commercial paper minus the federal funds rate versus the 3-month minus the 1 month. You can see really large spikes whenever stresses in the system are building. We saw that building all last year, and you can see this large gyration that's happened because of money market and debt ceiling concerns. So that's one sign. Of course, the other sign is the bank failures. At the very bottom down here, I have a new chart for you, which is total borrowing by banks from the Fed, and you can see how far that has spiked higher here. Now that has been coming down, so maybe we're thinking about, well, maybe the banks are going to get back to normal from here. Maybe the borrowing is going to stop, and I think that may be too soon, knowing that interest rate hikes are still on the table. And then finally down here, it's the bank term funding program that they released, and you can see that that's still accelerating, roughly $100 billion at the last report that was published here. To me, those are signs that policy is restrictive, so it makes a ton of sense for them just to hold. And what I would do is I would just continue to run the balance sheet down. You've got $3.3 trillion of total reserves. Depending on which floor you look at, you have about $1 trillion that you can run that down over time. And that ultimately gives you a lot of runway here from here to here, that you can run that in the background. That still acts as a form of tightening on the economy. You've got the tightening on the credit side as banks stop lending. You got tightening on the monetary side because you're doing quantitative tightening and you're selling assets back into the marketplace. So to me, I definitely think that this is where they should be focused and less on the interest rates. The interest rates, I think, are right-sized at this point. Will they do that or not? I don't know. Let's take one more look here at some more data, which is some money supply data. We talked about that maybe it's a good idea for them to just look at the balance sheet. Well, let's just look at broad money. We're starting to really remove all of that excess liquidity that's been put into the system as well. And so they can just continue that progress, right? The fact that they had almost $1 trillion plus above the trend rate of growth in the money supply, and now they're running at 1.6 trillion below that growth rate. That to me says a lot. That says that their policy has been working. This is also probably another sign of stress that's been built up. Here's currency in circulation, barely below trend. So again, but still coming down. And then demand deposits, and you can see demand deposits are still basically right in line with trend. So to me, I think the Fed should pause here and they should look at balance sheet runoff as their main tool going forward, as they continue to look for more data to confirm this. Right now, I think even the CME FedWatch tool has the majority of respondents, or the probability highest, on no change at all. So we'll see what happens. But they've got a tough decision to make here, and they really will come down to the wire with the fact that next week you're going to get the inflation rate and you're going to get the PPI rate right before they meet. Before I dig into the other data that you're going to get this week, I'm going to close on just one more thing for you. The Fed is going to also provide their summary of economic projections, and they have been highlighting that they expect, of course, below trend economic growth. So trend to them is about 1.8%. So they think growth is going to come in lower than that. I think prior they had around 1%. Or around 0.6%. 0.6% is right in line with what the Philadelphia Fed professional forecaster survey data highlights as well. So that's one thing that they're looking at. They're expecting the unemployment rate to rise back to the natural rate, which is roughly 4.4% right now. And then they also expect inflation to come back down to 2% by year end. I'm going to show you my forecast as well to give you an idea of what I'm thinking about. It's very close to the Fed with some slight differences. So the very first thing is I tend to create these models out of looking at the gaps between the actual output versus the trend, the actual unemployment versus the trend, the actual inflation rate versus the trend. And that's typically how these are created here. You're looking at the fact that, yes, I do believe you're going to have below trend growth. Trend is setting here, of course, at 0. So, we're still hovering just touch above trend, or right near it, basically. You can see that it's just barely above it. But you're going to see that I'm expecting it to stay below trend for the next 3 quarters as we try to kind of muddy along here. And that's going to make it look really similar to the growth scare of like 2015, so to speak. Moving on to the employment cycle, I expect employment to increase back above the natural rate. So the natural rate, again, being 4.37 is where it's at right now. And so you can see when we start to add these back in that you're going to get, really close to 4.5, maybe 4.56, somewhere along those ranges is where I'm expecting unemployment to go. And then finally, on the core PCE inflation, again, this is minus the target. So the last report was 5. So you're looking at 3.8, 3.6, and 3.18. I don't have it going back to 2. I have it basically remaining sticky at around 3% or so. So we'll see how that plays out when they release their summary of economic projections, but I believe that that's at least my likely path as well. So remember too that this is not the only data that we need to care about. I mean, the data that's coming out this week You've got the New York and Philadelphia manufacturing survey data as well. That should continue to paint a picture that manufacturing is still struggling. Then you move into things like retail sales data, industrial production data, and then you've got the Michigan Consumer Sentiment Report that's going to come out as well. So a jam-packed week after having a really light data week prior week here. So I hope this helps. There's a lot going on out there with the market rallying, but yet there's still concerns. One of the things that I would highlight is as the market starts to gather some steam, as the economy starts to reaccelerate in demand, that's going to stick some level of inflation in here. And that's, again, going to make the Fed's job, I believe, a little bit difficult on how they're going to decide to conduct monetary policy in this environment. Do they stay tunnel visioned and only look at inflation and say, look, we're going to get back to 2% as quick as we can? And if we do that, then maybe, just maybe, even though we may cause a little bit of pain along the way, at least we'll achieve our mandate. Or are they going to be a little bit more flexible? Is the Powell pivoter going to come back because he has pivoted quite a bit in the past? Will he do that again? That would be more fuel for the bulls that are already in session here, as the S&P, as I saw some headlines, has entered a new bull market now that it's up 20% since October. We'll see. I think that's why my sideways consolidation call, of course, getting challenged right now. It's a big reason why I think it still has some validity here. I think as we continue to look at this, there's just as much good data as there is bad data out there right now, or just as much optimism as there is pessimism, if you will. And so I think they're going to be washing each other out until we finally get better company earnings, until we finally get the interest rate decisions and conversations behind us, and as we finally get the inflation problem out of here. As those dominoes keep falling and you keep the geopolitical tensions in check, I think the market ultimately will start moving higher again. But again, I think there's some ground that needs to be covered left to go before you break out of this quote unquote channel that I'm watching and looking at here. So with that, I think that's a great place to stop. I hope everybody has a great week. I know there's a lot of data coming out, so stick with us. We'll bring you another update next week. If you have any questions at all, don't hesitate to leave a comment below or shoot me an email. I'm happy to answer those for you. If you like these videos, subscribe, like as well. We're going to continue to pump these out weekly as best we can. So stick with us as we continue to try to provide you these updates. I appreciate your time, and we'll be back again next week with another update.